Markets are constantly in a state of uncertainty and flux, and money is made by discounting the obvious and betting on the unexpected.
Soros recognizes that successful investing often involves betting against conventional wisdom and finding opportunities others overlook.
It's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong.
Soros stresses the importance of managing risk and maximizing gains when making investment decisions.
I'm only rich because I know when I'm wrong. I basically have survived by recognizing my mistakes.
Soros emphasizes the importance of recognizing and learning from one's mistakes to achieve success in the financial world.
The financial markets generally are neither efficient nor predictable.
Soros challenges the notion of market efficiency and highlights the role of unpredictability in financial markets.
The markets are constantly in a state of uncertainty and flux, and money is made by discounting the obvious and betting on the unexpected.
Soros suggests that opportunities for financial gains lie in recognizing the unexpected and going against the consensus.
If investing is entertaining, if you're having fun, you're probably not making any money. Good investing is boring.
Soros emphasizes the importance of maintaining a disciplined approach to investing and avoiding impulsive decisions.
The worse the situation becomes, the less it takes to turn it around, and the bigger the upside.
Soros highlights the potential for significant gains when investing in assets that have reached their lowest point and are poised for a recovery.
The financial markets generally are unpredictable, so that one has to have different scenarios. The idea that you can actually predict what's going to happen contradicts my way of looking at the market.
Soros argues against the notion of accurately predicting market movements and emphasizes the importance of adapting to different scenarios.
If investing is entertaining, if you're having fun, you're probably not making any money. Good investing is boring.
Soros suggests that successful investing requires a focus on fundamentals and a long-term approach rather than seeking excitement or short-term gains.
The way to build long-term returns is through preservation of capital and home runs.
Soros advocates for a strategy that combines the preservation of capital through risk management and seeking occasional big gains.
When I see a bubble forming, I rush in to buy, adding fuel to the fire. That is not irrational.
Soros shares his contrarian approach, indicating that he takes advantage of market bubbles by buying when others are selling with the intention of profiting from their eventual rise.
I think that my advantage as a philanthropist is that I can take unpopular causes and support them.
Soros recognizes his philanthropic efforts and the unique position he holds to support causes that may not be popular, but are aligned with his values.
The main difference between me and other people who have amassed this kind of money is that I am primarily interested in ideas and I don't have much personal use for money.
Soros reveals his focus on ideas and the pursuit of knowledge rather than personal accumulation of wealth.
The worse a situation becomes, the less it takes to turn it around, the bigger the upside.
Soros highlights the potential for significant gains when investing in assets that have reached their lowest point and are poised for a recovery.
Financial markets, far from accurately reflecting all the available knowledge, always provide a distorted view of reality.
Soros challenges the notion of market efficiency, suggesting that markets do not always accurately reflect available information.
People always thought I was controversial, but the truth is I have not been controversial. I have been right.
Soros defends his controversial image and asserts that his views have often been proven right over time.
It is not whether you are right or wrong that is important, but how much money you make when you are right and how much you lose when you are wrong.
Soros stresses the importance of risk management and the ability to capitalize on successful investment decisions.
The market tends to underestimate the probability of extreme events.
Soros points out that the market often fails to properly assess the likelihood of significant and unexpected events.
I rely a great deal on animal instincts.
Soros acknowledges the role of intuition and instinct in his investment decisions, along with thorough analysis.
Investors need to be contrarian and to be prepared to go against prevailing opinion.
Soros advises investors to challenge prevailing opinions and to consider contrarian strategies in order to identify potential opportunities.
The stock market is a device for transferring money from the impatient to the patient.
Soros suggests that successful investing often involves a patient approach and not succumbing to impulsive trading.
The main concept is that in order to succeed in the financial markets, one has to be a contrarian.
Soros highlights the importance of adopting a contrarian approach in order to find opportunities and avoid following the crowd.
It's not about being right or wrong, but about how much money you make when you're right and how much you lose when you're wrong.
Soros emphasizes the importance of managing risk and capitalizing on profitable opportunities in investment decision-making.